Good morning. I got an interesting question about the Australian dollar this morning. Will it go to 71 cents? And I had to have a stop and a think and a look at the chart and consider my AusBiz TV show yesterday, which you must look at, by the way, about the Reserve Bank, etc. But on the Australian dollar, we had US CPI inflation contracted 0.1%. Prices are finally falling in the US. Well, they've stabilized, which would be an absolute miracle for the American people and a fabulous outcome. Now, the Federal Reserve is definitely going to cut rates. It will want to look responsible, so it will wait till probably not cut at the next meeting, but the following meeting, because that way it looks like, oh, it didn't just jump at the opportunity to cut rates. It actually stood back, considered everything, was very serious, had a think, and then very carefully cut rates. The US economy should already be seeing rate cuts, so it will be a late shift by the Federal Reserve. For the Australian dollar, this means, of course, everyone wants to sell the US dollar because the Fed will cut rates. But the interest rate differential will still favour the United States across many currencies. Plus, it still remains a very strong safe haven currency. Minus, I think it has one of the world's worst burgeoning fiscal crisis going in the wrong direction, that's for sure. And spending is completely out of control, and it probably won't change with the change of leadership, which is looking to be quite likely from Biden to Trump. So none of that's going to change. So the US economy is slowing. It has negatives. It has safe haven. It still has a strong interest rate. So the selling of the US dollar may be getting ahead of itself. People in Australia and New York fund managers have been buying the Australian dollar because they believe the Reserve Bank of Australia may in fact hike rates once or twice this year. I think what's going to happen is the Australian economy is going to nosedive into recession. It may already be in negative growth this current quarter. We don't have the data yet, but I think the Australian economy is in trouble. It's slowing rapidly. It's going to flatline or go into recession. It could be a deeper for longer recession, and in that environment, this is the outcome for the Reserve Bank of Australia. It's either going to, again, mistakenly raise interest rates, big error if it does, but that's looking likely at the moment because they tend to make mistakes. So they're probably going to, one of two scenarios for the RBA going forward. They raise rates once more, and then after a period of time, they realize they got it wrong and they start doing panic cuts because the economy is tanking and inflation's dropping away because the economy is tanking. Or they don't raise rates because they tend to follow whatever the Federal Reserve does. I mean, sometimes they were just copying and pasting from the Fed statements into the RBA statements during the COVID years. It looked that way. So now that the Fed could be cutting interest rates, now that the US has had a negative month, down 0.1% on the CPI, but there was some encouraging data. But also, I said in advance, it could be a good CPI number because gasoline prices were down and they did in fact fall. So they'll see that and they'll say, well, the US has got slowing inflation now. We might follow them. The US Federal Reserve is probably going to cut rates this year. We always follow them. So what I'm trying to say is the RBA may not raise rates at all. So the RBA may not raise rates at all and will be forced to cut as the economy slows, or the RBA will make another mistake and then have to double up cutting after that by year end. So in either of those outcomes, all of this speculative buying of the Australian dollar based on the idea that the RBA will raise rates, the Fed will cut, is really getting ahead of it. Well, it's actually just plain wrong in my forecast book. It's plain wrong. So that leaves a market that's mega long with the wrong idea. And when that happens, you get sharp reversals. So if the Aussie were to fall back below 67.45 cents, I think that would be a trigger point to confirm the scenario I just mapped for you, that the whole market is long and wrong and will need to get out. And then the Australian dollar could fall sharply. And there's a lot of fundamental reasons why the Australian dollar would fall sharply back to 64, 63, 62, 61 cents. And that is a fast slowing, so not fast slowing, a deeply slowing Australian economy. And the global trade environment is still vulnerable. And we are we don't have the best diplomatic relationship with China as we once did, and they are tending to buy their resources from elsewhere, which means our external trade situation will be good, but not as good as it could have been, and the local economy will be falling, and interest rates will be going down. So I think we could have a scenario by the end of the year in Australia where both the Australian dollar and the Australian stock market are pretty much in decline. And on the stock market question, just think about in the US how much buying has gone on for 2 years now on the idea the Fed will cut rates, expecting 6 to 7 cuts this year. So all of that is priced in, and yet we might only get 1 or 2 rate cuts from the Fed this year. But it's so fully priced, is my point, that the long-awaited built-in pricing, continuous buying for a Fed rate cut to make money by speculators could actually be one of those buy the rumors, sell the fact events on a massive historic scale. So as we go into Fed cuts, I think a US stock market top becomes more likely, not less likely. And I think that could feed into the Australian market at a time the Australian economy is slowing, so the Australian stock market would be very vulnerable. Now, in terms of price action, the Australian stock market looks very strong at the moment. In terms of price action, the Australian dollar looks reasonably firm now. But note the price action during New York, in the latest trading session just finished in New York, the Australian dollar had that spike high, as the euro did, fell back. It was all about a US dollar move. But the nature of the fallback suggests there could be some buying of the Australian dollar following on from the US CPI today during the Australian time zone when it gets very liquid. But I would give, if you see 67.50, 67.45 broken for the Australian dollar, that's a trigger point for the scenario I've just mapped, and it would mean the Australian dollar is probably in a bear trend for many months to come. I hope this helps. Have a great day. Don't forget my website, cliverbennett.com.au, and don't forget to have a look at propx24.com as well. Thanks very much. See you.